This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
So long and farewell. The Federal Reserve ends its bond buying program, upgrades its assessment of the economy, and pledges to keep interest rates low for a considerable time. So what will Chair Janet Yellen do next? The $1.6 trillion question. Did the central bank's historic move to stimulate the economy work? And the Fed effect. What happens to the housing market now that the stimulus program is over? We have all that and more tonight on Nightly Business Report for Wednesday, October 29th. Good evening, everyone. Tyler is off tonight. They say all good things must come to an end, and today, the Federal Reserve announced the end of its latest bond-buying stimulus program known as QE3. The decision ends a 6-year stretch where the central bank expanded its holdings of treasuries and mortgage-backed securities to an unprecedented $4.5 trillion. In a statement after the Fed's two-day policy meeting, policymakers also gave an upbeat report on the health of the U.S. economy and the job market. The U.S. dollar spiked higher on the news, bond prices dipped as yields moved up, gold prices fell a bit, and cautious investors kept the markets in negative territory. The Dow lost 31 points, the Nasdaq slipped 15, and the S&P was off about 3 points. The yield on the benchmark 10-year note hit a 3-week high today before easing back and closing at 2.3%. Hampton Pearson has more on the Fed's decision.
Just a few hours after Janet Yellen arrived at Federal Reserve headquarters, the Fed chair and her fellow monetary policymakers made history, ending the central bank's multi-trillion-dollar bond buying program nearly 6 years after the financial crisis. But the Fed will continue to keep interest rates at historic levels for a considerable time, even as the asset purchase program comes to an end. Key money managers say the move is long overdue.
I've been of the view the Fed's a bit behind the curve, given all the numbers we look at. I'm glad they've moved there. I'd like to see the Fed go sooner. That would mean the economy's stronger, earnings going to be better. I think that's good for the stock market.
While the Fed is ending QE this month, comments from policymakers about labor market conditions and the outlook for inflation are heating up the debate over what's next for key short-term interest rates. With the job market improving and unemployment now at 5.9%, the FOMC statement suggests there may be less slack in the labor market. Policymakers say that the underutilization of labor resources is gradually diminishing. And while lower energy prices may keep a lid on inflation in the short run, the Fed now says the likelihood of inflation running persistently below 2% has diminished somewhat since early this year. Fed watchers say the slightly more hawkish tone could move up the timetable for an interest rate hike.
I think a lot of the people that were looking for the Fed to use inflation as an excuse to take their time might be a bit disappointed, because it seems what the Fed is saying is we're looking past this period of weakness.
Even at a moderate pace of economic growth, this labor market is tightening up fast. I think the real key to whether we get a rate increase even as early as March is what do wages do from here.
The U.S. economy is enjoying increased business and consumer spending, manufacturing growth, and an unemployment rate at a 6-year low. But housing is still struggling, and the slowdown in global growth poses the biggest threat to the recovery. For Nightly Business Report, I'm Hampton Pearson in Washington.
Now that QE3 is over, the big questions: why did the Fed launch that third round of asset buying? And did the central bank's historic spending experiment really work? Steve Leisman takes a look.
The Fed's decision today to end the third round of quantitative easing leaves one simple $1.6 trillion question. Did it work? Did the $1.6 trillion of bond purchases in the program's 2 years achieve the Fed's goals of helping the U.S. economy, pumping up inflation, and lowering the unemployment rate? There's two ways to look at it. You can start with the U.S. data. Since QE3 was launched, growth has been a steady, if unremarkable, 2.5%, about a half point higher than it was before the program. Job growth ratcheted up from an average of 110,000 per month to 245,000 now, and the unemployment rate fell by about 2 points. The stock market surged. But another way to find out if QE worked in the U.S. is to look at Europe. Over the same time that the U.S. bought hundreds of billions of dollars of bonds, the balance sheet of the European Central Bank declined by €1 trillion. Now, central bankers on the continent are fretting over economies that are near recession and teetering on the verge of deflation.
History has told us that those central banks who tighten too soon have a lot of consequences that they then cannot deal with after a financial crisis. And the biggest mistake they can make is repeat 1937, repeat the Japanese situation, or repeat many European missteps more recently, and they don't want to be there.
Of course, QE had its failings. While the Fed tried to boost inflation, it actually declined during QE3. Bank lending has failed to rise strongly despite the Fed pumping billions into the system, and housing has floundered despite low mortgage rates. But supporters of the program say, just look at Europe. It could have been much worse here in the U.S. For Nightly Business Report, I'm Steve Leisman.
Joining us now for more analysis of today's Fed decision, we're happy to have with us Robert McTeer. He's former president of the Federal Reserve Bank of Dallas, and Russ Kosterich, global chief investment strategist at BlackRock. Gentlemen, thank you so much for joining us on this big day. Bob, let me begin with you. So QE is over. How do you think the economy does from here? Does it continue to grow or does it stall out?
I think it continues to grow. We're no longer adding stimulus, but stopping QE doesn't take any stimulus away. The Fed's balance sheet is still intact, and there are a lot fewer bonds on the market because they're owned by the Fed than there would be otherwise. So the effect of the stimulus will still linger.
And how much does it grow?
Well, I think at the very least, the 2 to 2.5% it's been growing. I would think probably up closer to 3 by now.
Mm-hmm. So, Russ, stocks were in the red in reaction to all of this news today. Not by a whole lot, but they were on the downside. What is the market response?
I think the market response was fairly muted. Stocks were down a bit before the announcement. They actually recouped some of those losses. Yields ended just about where they were this morning. So not a lot of reaction. Most investors expected QE to end. If anything, I think people were a little bit more interested in the Fed language than the end of QE, which was widely anticipated. So
what happens with the markets going forward from here, Russ? Do you see more volatility, less volatility?
I think we see modestly more volatility. I do believe that stocks can move higher. Valuations are not cheap, but they're reasonable. Fundamentals are relatively sound. But what is likely to be different is we're probably moving into an environment in which volatility is going to be somewhat higher than the very low levels we've had the last couple of years. And arguably, we've already had a taste of that since the start of September.
You know, a lot of what's going to happen in the markets, Bob, is going to depend on what the Fed does with interest rates. You served in many of those meetings where decisions were made about raising interest rates. What do you think? So you know how the Fed decides these things. So what do you think the Fed is going to do? When are they going to start raising interest rates, and by how much on the first move?
I'm guessing that it'll be in the middle of next year, somewhere around July when they start. Mm-hmm. And I believe the first move would be to go to 0.25% on the Fed funds rate. It's now considered between 0 and 0.25%. So I think they would start with 0.25, and they would go slow, and they would make it clear that they were going to go slow. Mm-hmm. We're not going to have high interest rates anytime soon.
Mm-hmm. Russ, is that how you see it? And how do you think the markets would respond to that plan?
I think that is it. I do believe it will be a very slow process, given the fact there is not much inflationary pressure. And this is pretty much what the markets are discounting. If you look at where expectations are, somewhere next summer, next fall, we're likely to see the start of that tightening cycle. And I think the key thing for the markets is assuming that tightening cycle is happening in the context of a stronger U.S. economy, better growth, then I think stocks can continue to move higher despite having somewhat higher rates.
Let me ask you this too, Russ. How important is all this news coming out of the Fed today for individual investors? Do they need to make changes in their portfolios, whether we're talking about stocks or bonds?
Well, you know, it's an excellent question. I think the short answer is no. First of all, as we said before, most of what happened today was largely discounted. And I think for most individuals, the good news is we're moving into an environment which should be closer to normal, where the market is more driven by economic and company fundamentals than by every utterance from the Fed. So I think for most investors, they should keep to their investment plan. Nothing that happened today should really lead you to change that.
Bob, we heard from the Fed today saying that they're seeing substantial improvement in the job market. We're getting the next jobs report in about a week or so. Do you think we're going to see a continuing trend of robust hiring with the unemployment rate coming down?
I think so. The new claims data in the last few weeks have been fairly encouraging, and we now have several months of over 200,000 new payroll jobs. So it probably won't be as good as the September report, but I think it'll be pretty good.
And Russ, is that what you see? And also, can you give us real quickly what you think your year-end forecast for the Dow is going to be?
Well, we do think we're going to continue to see improvement in the labor market. Again, we've seen an environment in which initial jobless claims will remain low. That should be associated with 200,000 or better monthly non-farm payroll. I'll give you some views on the S&P, if that's all right. We do think that stocks will make some modest gains for the remainder of the year, with the S&P 500 ending probably somewhere between about 2,000 and maybe a bit better than that, maybe about 2020.
All right. Thank you so much, Bob, Russ. Really appreciate you coming on the program.
Thank you.
We've been speaking with Robert McTeer, former president of the Dallas Federal Reserve Bank, and Russ Kosterich with BlackRock. Well, as the Fed tapered its Treasury purchases over the last year, U.S. banks have been picking up the slack. Since December, records from the St. Louis Fed show that commercial banks bought up $115 billion worth of Treasuries and another $60 billion in agency mortgage-backed securities. Banks are expected to keep stockpiling these safer assets in order to meet stricter federal regulations. And later in the program, why small business owners haven't been borrowing and taking advantage of low interest rates. Kate Rogers will bring us that story. Well, now that the Fed stimulus plan will end and super low interest rates will go eventually higher, what will the impact be on housing? Diana Olick joins me now from Washington. So, Diana, first let's just look at the past. I mean, did these lower rates really boost home buying over the past 6 years? What have you seen?
Well, not home buying so much. What they really did was to help millions of borrowers refinance into lower rates. We saw rates go from just above 6% back in 2008 to as low as 3.5% just a year and a half ago. That, again, helped people refinance, but it didn't necessarily push as many home buyers as expected. What we did see, though, was other stimulus from the government, being the first-time home buyer tax credit. That really juiced home buyers briefly in 2009 and 2010.
And were there any negatives to all this? What was the downside of these super low rates? Were there any adverse effects that impacted housing?
Well, for one thing, a lot of investors were seeking yield. And so because they couldn't find it from the government, they went into real estate and they started buying up on the very low end of the market. Now, that was arguably a very good thing because they bought all those distressed properties and helped put a floor on home prices. The problem was that investors had all cash. They bought so many properties, competed for these properties, and pushed home prices up much higher, much faster than expected and faster than normal income growth. So now home buyers who are coming into the market, mortgage dependent, are looking at far higher home prices than they expected. So that one really turned out to be a double-edged sword.
And now going forward, we know that mortgage rates eventually are going to go higher. And what is that going to do to home buying? And especially now that the Fed is going to be out of the picture and is not going to be buying any more bonds.
Well, we already know rates jumped higher just this afternoon after the FOMC announcement. We know that they're at the highest rate now in just the last 3 weeks, but they didn't jump dramatically higher. They're still hovering near 4%. We will see rates inch slightly higher, but it will not be a big dramatic move. And what's important to note is that it hasn't been the rate, but the credit availability that's really affecting home buying today. It's buyers who need to have good credit. They need to have a down payment. They need to have full documentation. So I don't think we need to worry quite as much about the rate as we do about that credit availability going forward, Susie.
Absolutely. The process is really long for any of us that have gone through all of this. Thank you so much, Diana Olick in Washington. And still ahead on the program, Twitter and Facebook are two very different businesses, but they're both struggling from some of the same issues. That story is next. Any investor will tell you that every second counts when executing a trade. And 2 new studies have found that hedge funds, high-frequency traders, and others are paying for access to market-moving data from the SEC regulatory filings seconds before other investors. That gives them a potentially unfair edge over the rest of the market. The findings from researchers at the universities of Colorado and Chicago show the difference in data, the data releases ranges from milliseconds to as much as a minute. The new mobile payment systems that's taking on Apple Pay has already been hacked. Currency, this is the fledgling payment system that's backed by a consortium of retailers, including Walmart, Rite Aid, and CVS, is sending emails to pilot customers warning them that their email addresses may have been stolen. A more familiar payment system posted solid quarterly earnings after the market closed today. Visa, the world's largest credit and debit card processor, beat Wall Street forecasts as more people charge more on their credit cards. The better-than-expected report came despite a drop in net income and as Visa set aside nearly $500 million for litigation costs. Adjusted earnings of $2.18 a share were 8 cents more than analysts expected. Revenues of the Dow component also topped estimates. And after maintaining its 2015 earnings guidance and announcing a $5 billion stock buyback plan, shares were up sharply in after-hours trading. Mary Thompson has been going through all of the numbers. She joins us now. And Mary, I know you've been looking at all this stuff. If there were one key takeaway from this report, what would it be?
I would have 2, if that's okay, and I'll make it quick.
Why
The first one is that Visa continues to be investors' friends. That $5 billion stock buyback comes on the heels of a 20% increase in its dividend, which was announced earlier this week. But the company performs well despite some headwinds, those being low volatility in currencies, the threat of Ebola. They mentioned also concerns about modest economic growth. What you want to see is a couple of things from Visa going forward: an increase in cross-border volume, which is challenged because of the economy and the currency volatility. And then second, what it's doing with its digital platform, because these payments are only 19% of its business right now, but it's the most rapidly growing area. We know they're a partner with Apple Pay, and they say their early results from this so far have been encouraging, but that's not all they're planning. That's their focus right now.
Oh, that's very interesting, because that sort of follows up with what Tim Cook from Apple said the other day. All right, Mary, thank you so much. Mary Thompson reporting on Visa's earnings. WellPoint says more people signed up for its insurance, helping it post strong earnings, and that's where we begin tonight's market focus. The company reported higher than expected profit as its medical costs stayed low. WellPoint also hiked its earnings outlook for the year. Shares rose $2.20 to $122.20. Shares of Hershey melted after it reported an earnings miss. The candy maker also gave a trifecta of reasons for poor sales guidance for the year, including higher milk prices, a stronger dollar, and weak overseas sales prospects. Shares fell 1.5% to $94.06. Ralph Lauren also disappointed with a dismal sales forecast. It lowered its guidance for the current quarter and the year, blaming unfavorable foreign currency issues. Its profit topped estimates, but its revenue came in short of estimates. Despite all of that, shares rose a fraction, closing at $161.79. After the bell, Kraft announced that its profit fell as price hikes hurt sales. Those increased prices were designed to offset higher commodity costs, but sales of some of Kraft's meat and cheese products suffered. Shares were down initially in after-hours trading. During the regular session, though, the stock was off just slightly to $56.91. And old tech and new tech are teaming up. IBM announced a new partnership with Twitter to deliver data analytics, which will be available through Big Blue's cloud service. The goal is to help shape business decisions using data collected from tweets. Shares of IBM were off slightly at $163.46. Twitter down almost 4% at $42.08. And Twitter had some company shares of Facebook also lower, despite posting better than expected quarterly results, which we reported to you last night. Twitter and Facebook may operate 2 very different businesses, but as Julia Boorstin tells us, both social media companies have something in common, especially through the eyes of Wall Street investors and their vision for the future.
Facebook has over 1 billion more active users than Twitter, and Twitter conversations are public, while Facebook's are more between friends. But the 2 company stocks are both suffering from forecasts that disappointed Wall Street. Twitter hit by concerns it's not growing fast enough, Facebook by slowing revenue growth and an upcoming jump in expenses.
The critical question here is just around expenses. the level of expenses, the spending that they're going to ramp up next year, and we felt like that's going to have an impact on the price target.
Both companies also laid out a vision for extending their reach beyond their own social networks, providing the tools to developers so they can be the backbone of all variety of mobile apps and provide ads for them as well.
Over the next few years, our goal is to make Facebook the cross-platform platform that allows developers to build, grow, and monetize their apps across every major mobile platform.
Just last week, Twitter jumped into this game, unveiling its developer toolkit called Fabric to help developers even with apps that have nothing to do with Twitter.
Fabric is about being part of the foundation of the entire mobile application ecosystem, helping developers around the world build apps across platforms from the moment they start developing them to the day they want to start monetizing them at scale. If we are part of the foundation of every mobile application in the world, then enormous opportunities will accrue to us.
But some analysts see the pullback as an opportunity, saying the company's stocks should not be moving in the same direction.
We did downgrade Twitter. The metrics are moving in the wrong direction at Twitter. They're moving in the right direction at Facebook. The valuation's much more demanding at Twitter than it is at Facebook.
The question, how both CEOs will deliver on the plans they laid out this week. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Coming up, Wall Street is keeping a close eye on the Federal Reserve's next move, but are small business owners doing the same? That story right after this. Alliant Tech Systems is reportedly reevaluating its merger with Orbital Sciences after Orbital's unmanned rocket exploded into a fireball last night, just moments after liftoff in Virginia. Orbital's rocket was carrying 5,000 pounds of food and supplies to the 6 people on board the International Space Station. No one was injured, but Orbital shares plunged almost 17% today, and Alliant Tech Systems fell 6.5%. Well, if you've ever dreamed of owning a Ferrari or just a piece of one, this might be your chance. Fiat Chrysler plans to spin off the iconic Italian sports car maker, selling a 10% stake in Ferrari, listing it in the U.S., and using the money to fund expansion plans. Shares of Fiat Chrysler revved higher today, up nearly 12%. UPS is predicting record deliveries this holiday season, forecasting more than 585 million package deliveries in December. That's up 11% from last year. UPS expects its peak day will be December 22nd, when 34 million packages will be delivered worldwide. Circling back now to our top story, the Fed and the end of its stimulus program. Those record low interest rates were designed to jumpstart lending. But did they help small businesses as well as big ones? Kate Rogers reports.
Low interest rates would seem to be a positive for small businesses, allowing them to access cash for cheap. But for Patrick Martins, owner of Brooklyn-based food wholesaler Heritage Foods USA, low rates are hardly a consideration when it comes to making business decisions.
I make $8 a pound on chops, and if I could make $9, that is a lot more meaningful to me. To go up $1 a pound on 60,000 pounds of meat a week is much more powerful than worrying about things outside of my control.
And Martin's not alone. A Pepperdine Capital Index survey finds nearly half of small companies saying the current business environment is holding them back from growing. Main Street is seeing a lack of consumer demand and sluggish spending across many industries.
Experts say that low interest rates actually matter less to small business owners compared to consumer spending and overall economic confidence.
In fact, the latest optimism index from the National Federation of Independent Business finds only 2% citing financing as a top business problem, and half flat out saying they don't want a loan right now, as low rates have not triggered the growth in spending that would promise a good cash flow on business investments.
The numerator is what counts. That's expected sales, profits, cash flow, and that, of course, doesn't look very good.
Martin's relies on a line of credit, which is easier to access. Other small businesses have turned to alternative lenders, which have easier application criteria.
It doesn't force me to dedicate too much of my time, with banks, talking to people, contracts, filling out forms. I can concentrate on finding chefs to spend more for our meats because they're the right kind of meats.
In the end, it's really all about demand. So while Wall Street is eyeing the Fed for any clues about when interest rates will rise, it's likely Main Street won't care much either way. For Nightly Business Report, I'm Kate Rogers.
And that is Nightly Business Report for tonight. I'm Susie Garob. Thanks for watching. We'll see you tomorrow.
Nightly Business Report has been brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
I'm Susie Garob with a Nightly Business Report news brief. The Federal Reserve announced the end of its bond buying stimulus program known as QE3, but for now it's keeping benchmark interest rates at record low levels after giving an upbeat report on the health of the U.S. economy and the job market. Cautious investors kept the markets modestly lower today. The Dow lost 31 points, the Nasdaq slipped 15, and the S&P off about 3 points. Visa reported strong earnings as more shoppers spent more on their credit cards. IBM is partnering with Twitter to deliver data analytics on tweets available through Big Blue's cloud service. And here's your chance to own at least a piece of Ferrari. Fiat Chrysler plans to spin off the iconic Italian sports car company into a separate company. Be sure to tune into Nightly Business Report right here on your public television station.